Welcome to an introduction to managerial accounting, brought to you by Parkbench Tutors and narrated by David Hopcroft. For more information about Parkbench Tutors, please visit parkbenchtutors.com. In this second podcast, relating to the time value for money, we look at internal rate of return, payback method, and accounting rate of return. We will also discuss the Depreciation Tax Shield. The first podcast on time value of money considered the net present value method. Here we start with the internal rate of return. This means we consider a rate of return that will equate to the present value of all future cash flows or investment. The method considers the return that makes the net present value equal to zero. If the internal rate of return is equal to or greater than the required rate, then the investment can be accepted. If the internal rate of return is less than the required rate, then the investment should not be accepted. The present value is equal to the present value factor multiplied by the annuity. So, to determine the present value factor, we divide the present value by the annuity. If an investment is made of $100 that requires a yield of $70 for each of 3 years, then we can calculate the present value factor by dividing 100 by 70, which gives us a value of 1.43. Using tables to look up a value of 1.43 over 3 years, we get a rate of return figure of between 20 to 30%. What happens if the cash flows that are predicted for each year of the investment are not equal? In practice, what we can do is to make an estimate to calculate the rate where the present value is zero. If the estimate gives a rate of return that is greater than zero, then the estimate should be increased. If the estimate of internal return gives a value of less than zero, then the estimate should be decreased. This trial and error method can be made much easier by the use of spreadsheets. Although the revenue resulting directly from the investment is the obvious benefit, there may well be other benefits for making the investment. Accountants refer to these as the soft benefits. Although they are often difficult to estimate, they may be important and significant, especially when related to new developments in technology. A company considering the investment in technology for a new control system for automobiles using a number of sensors might wish to consider what the soft benefits could be. What sort of sensors will be developed, and would they be of use in other projects? Are there any other industries that might make use of the sensors? Could the software be modified and used in other products? The development of sensors has already led to easier parking and reversing. There may well be other opportunities. The determination of the soft benefits is bound to be something of an estimate, but is often done as a requirement when a project does not reach a required present value. The procedure is to look at the present value that would be needed and to multiply the value of the benefits by the discount factor. So, to determine the value of a benefit that would be needed, we take the present value needed and divide by the discount factor. For example, a business currently has a net present value calculation that is negative and wants to look at the figure that would be required for soft benefits. Soft benefits will need to provide additional cash flow to get a positive value for net present value. Currently, the net present value is minus $50,000. A rate of return of 10% is required over the 9-year life, which from discount tables gives a discount factor of 5.759. The value of benefits required will be equal to 50,000 divided by 5.759. This gives us a figure of $8,962. The soft benefits would have to be equal to $8,962 or more a year to make the project investment worthwhile. How is the estimate of the required rate of return made? The rate is related to the cost of capital to the business, which includes the cost of debt and any equity financing. The cost of debt figure comes from the need to pay interest for borrowing money, and the equity return is that rate which shareholders will need in order for them to be convinced of supplying capital to the business. The cost of capital will not be the same for every business. A business associated with e-commerce may have a high risk, and that may require a higher rate of return. A grocery business may be seen as a lower risk and have a lower rate of return, making it easier to raise capital for that business. Calculations of net present value refer to cash flow, and we must make the distinction between cash flow and revenues and expenditure. If a sale is made in period 1 and cash is received for that sale in period 2, then the cash flow that is discounted is the figure for period 2. Similarly, an asset purchased in period 1 and depreciated over 5 years will have the full sum as a cash flow in period 1. Whilst we appear to have ignored depreciation as part of cash flow, the amount of depreciation does have some significance. Depreciation is an expense that can be set against tax, so a tax saving will reduce taxes to be paid. Since this helps shield from some tax, this event is sometimes referred to as the Depreciation Tax Shield. Let us work through an example to show the tax depreciation shield. We will consider the income statement first. The company with revenue of $50,000 has depreciation of $12,000 a year for 5 years. Operating expenses are $4,000. Income before taxes is $50,000 less $4,000 less $12,000, which is $34,000. With a tax rate of 40%, the tax will be $13,600, giving a net income of $20,400. From the cash flow statement, we shall assume all inflows and outflows take place in the same period as revenues and expenses. So, revenues represent an inflow of $50,000 with outflows of tax of 40%, making $20,000, and operating expenses of $4,000. We then add back the tax savings on expenses, $1,600, and on depreciation, which is 40% of $12,000, making a figure of $4,800. So the net cash inflow is the inflow of $32,400. We can state this more simply by stating net income as $20,400 from the income statement and adding back depreciation of $12,000 to give a cash flow of $32,400. On the income statement, note that depreciation is the only item that is not a cash flow. If the return required over 5 years is 6%, we can look up the tables to find this gives a present value factor of 4.2. Let us see how figures now measure up to the required rate of return. The investment of $60,000 has a present value factor of 1, so the present value is $60,000. The revenue less operating expenses and taxes is $32,400. Multiply this by 4.2 as the present value factor gives $136,080 and a net present value of $76,080. A rather healthy return. How do we take into account the rate of inflation and why? We multiply the current level of cash flow by an expected rate of inflation. It is important to realize that banks and lenders will already have made an allowance for inflation when they determine the interest rate for a loan. Their interest rate will be slightly above the expected rate of inflation. A less reliable method of determining the value of an investment is the payback method, which is simply how long it takes a business to recover the value of the investment. An investment of $5,000 with a cash flow of $2,500 each year has a payback of 2 years. An investment of $30,000 with a cash flow of $5,000 each year has a payback period of 6 years. Some businesses may set a payback period for determining whether an investment should be made. There can be disadvantages to setting a definite period for payback. If one project has a payback of $3,000 a year for 3 years on an investment of $8,000, then the return will be less than that for a project with the same investment, but where return is $0 in years 1 and 2, but $5,500 per year for years 3 and 4. You have probably realized another disadvantage. The payback method ignores the time value of money. Finally, we consider a further method, the accounting rate of return. Here, the average net income is divided by the average net investment. This method also does not take account of the time value of money. We will consider two projects and the cash flows over 2 years. Both projects have the same revenues in year 1, but due to differences in operating expenses, the net income for Project A in year 1 is $6,000 and that of Project B is $0. In the second year, net income for A is $6,000 and for B it is $12,000. Using the accounting rate of return for each project, we find we obtain the same figure for each project, a rate of return of 0.60. This would lead us to believe there was no difference between the two projects. However, we know that the time value of money has been ignored. If the required rate of return was 16% over the 2 years, then would the two projects have appeared to be identical? Let us consider the projects taking the time value of money into consideration. For Project A, we get a net present value of $17,790.80. For Project B, we get a net present value of $17,077.40. Now we can see that there is a distinct difference, and that Project A is a better choice. The way that capital budgeting is carried out is important because it may affect manager evaluation. If evaluation is based on profit each year, then managers will favour those investments that give a higher initial return. To benefit the manager and the business, the evaluations really must also consider the expected future benefits. This ends our second podcast on the time value of money, brought to you by Parkbench Tutors and narrated by David Hopcroft. Thank you for watching and for listening. We wish you success in your studies. For more information about Parkbench Tutors, please visit parkbenchtutors.com.